Good evening, everybody. On behalf of the Jamaica Stock Exchange and my colleagues here from Jefferies and our co-lead sponsors of this event, NCB Capital Markets, a heartfelt welcome. All of us that I just mentioned are really excited that this actually happened 2 years in a row, and we certainly hope it continues. We do a similar event in Jamaica. We've been doing it 17, 18, 20. Oh my gosh, 20 years, and hopefully we'll do the same here. Agnes Young, CEO of NCB Capital Markets, Steve Winningham, Chairman of the Jamaica Stock Exchange, Dr. Marlene Street Forrest, Managing Director of the Jamaica Stock Exchange, numerous honored guests, dignitaries, and as I always say, all other protocols fully acknowledged. Good evening. As we embark here towards the end of 2024, it brings me great solace that this conference will hopefully shine some rays of hope and excitement during these global challenging times. At Jefferies, we continue to remain a partner of these terrific Jamaica Stock Exchange events, as well as remaining totally committed to the entire Caribbean region as in general. It has always been a great honor over the past decades for me to be asked to give a few remarks during the opening ceremonies of these conferences, and it's a pleasure once again to be down here in Guyana. Actually, I've been involved with clients of this great country for over 15 years now, and I'm personally excited that such an event is occurring in this great country. As Managing Director of Jefferies, my mandate is to serve our clients with the absolute best we have as a firm. We pool our talent, our resources to create the best viable solutions for our clients, and in short, at Jefferies, we never rest on our laurels. The global markets, as you all know, are constantly evolving like I've never witnessed in the 40 years that I've been doing this business. But at Jefferies, we take pride in creating new opportunities for our clients and new ways of doing business. Innovation is king, but just know when it comes to Jefferies, the client always comes first. Before I dive in to chat a little bit about the global markets and Guyana in general, I've got to always give you all my disclaimer that these may or may not be the opinions of Jefferies LLC. For me to get up here, I have to make sure all the compliance, they say that I have to say that before I begin speaking. As we make the final turn into this final quarter of 2024, there are so many moving parts from an economic global perspective. And having just stated the obvious, I like to begin my remarks by focusing on the things that we know for sure rather than all the conjecture that we're reading about every day. First, the Fed put, which is the pivot, is now in effect. And that means that the Fed is now beginning to accommodate. Second, it has been my experience that when the Fed cuts rates, it means the U.S. has moved into some sort of disinflationary contraction mode. Third, we are now a few short days away from a very tumultuous U.S. presidential election, to say the least. Fourth, we are forced to contend with escalating wars throughout the globe. And finally, despite all this, the animal spirits within U.S. markets somehow have remained alive and well. Given all the knowns that I just listed, my ongoing investment thesis of playing a good defense in order to create a solid offense remains, from my personal years of experience, the thing that makes the most sense at this point in time. And more importantly, given the fact the massive waves of nonstop stimulus has finally been stopped, it has also been my experience that this is a normalized market cycle that is finally returning after decades of a hiatus. All truth be told, given the average age of an investment advisor on Wall Street, not many have ever experienced a normalized market cycle. From my perspective, normalized market cycles are not to be feared, but rather embraced. Well, embraced if you're at least positioned properly. The animal spirits persist when it comes to these overstretched equity markets, but declining yields and bonds is like the proverbial mosquito in the golfer's ear while he's trying to make that perfect putt. So let me be clear. Fed cuts are only bullish for equities in recessions if recessions are completely averted. And it seems that's the consensus view right now, that a recession has yet to show up in the United States. When it comes to bonds, you might be surprised that in a Fed easing cycle, they perform almost as well in a non-recessionary episode as they do in recessionary episodes. And please take note here, only half the decline of the 10-year note yield from cycle peak occurs at the first Fed cut. That's not conjecture, that's historical fact. It's history that I personally witnessed in these numerous decades in the investment business. So from my lens, I continue to place my bets on history and don't even need a recession to foster my unadulterated bullish feeling about solid fixed income credits. To put it in the most simplistic terms, the fact that the yield curve has pivoted to a positive slope historically spells the end of an economic cycle within the next few months or so. As in not exactly a bullish macro signal, a period of yield curve inversion followed by an uninversion has a 100% historical track record that some sort of contraction is probably on the horizon. So you may be asking why the current U.S. Treasury market has been acting a bit sloppy in recent weeks, especially after the Fed recently cut 50 basis points a few weeks ago. Let's review some historical patterns in order to understand what's likely to follow when it comes to the Treasury market. Back in 2007, when the Fed cut 50 basis points, the 10-year went from 5.25 to 4.75 yield. That's where the Fed cut. The 10-year actually pivoted higher yield like we're seeing in today's market. That's because back then, like today, investors bought into the view that the rate cut was better for stocks than it was for bonds. There were dreams and fairy tales back then in 2007, as in today, as a no landing scenario. However, by October in 2007, and a few months have followed, the 10-year hit 2.08%, and the recession began that nobody saw. The same thing happened in 2001. Sir Alan Greenspan cut 50 basis points in a surprise move, and the 10-year note actually spiked that same day from 4.92% to 5.14%. And of course, nobody saw the pending recession back then, and soon after Greenspan's move, the 10-year headed down a year later to a yield of 3.13%. My point here is that a jumbo initial rate cut occurs because the Fed wants to abruptly reduce some of the past lagging carnage caused by the previous tightening modes that they ushered in. And during this historical period of times, buying fixed income into inflationary cycles has always proven to be the right defense to play a solid offense. So let me repeat. In non-stimulus environments, markets always move in cycles, and they never remain in a straight line up or down. It remains my opinion that given the Fed's jumbo cut a few weeks ago, that this sought-after soft landing scenario will remain somewhat elusive. It remains my opinion that the Fed is just as much behind the growth curve as it was behind the inflation curve over 2 years ago. I don't think we're going to go back to zero rates, but from my years of experience, my gut is in a year or so, we should see the 10-year note around 2.25%. And that's just simple translation of a normalized market cycle. So why take the risk in seeking double-digit returns in an equity market with earnings numbers coming down that's already overstretched when bonds are offering similar returns if you remain steadfast and patient and lock in yields now? Economic contractions are not to be feared. Again, they are part of a normal economic cycle that has been absent for just too long. At Jefferies, we will use all our resources to help clients navigate and invest smartly during these moments when investors aren't really quite sure what to do next. I view a contraction as a bridge towards another expansion, a bridge that can be traversed across successfully if positioned properly. Fixed income usually fares better during disinflationary periods and even the beginning stages of a forthcoming expansion as well. I'd like to make a few comments about Guyana, which brings us all to this great conference. Guyana is now the home of the largest oil discovery in more than 10 years and will produce far more crude than even Exxon had originally forecasted. According to the IMF, Guyana's economy is forecasted to expand an additional 7.3% from its 2023 forecast of plus 40%. And its oil sector continues to expand at an unparalleled pace. As many of you already know, the Guyanese economy is now the fastest growing economy in the world, and it's not just about the oil either. And I think Agnes related to this. GDP, non-oil related, has grown over 12% down here as well, with all revenues that should enable significant investments in infrastructure, healthcare, and education. All this remains crucial for long-term economic stability and growth for this country of Guyana. Guyana's economic future looks overwhelmingly promising, but it will require careful management and strategic planning to ensure that the benefits of the growth are both sustainable as well as inclusive. Additionally, Guyana's success in strategic initiatives should also be enhanced with its leadership role within CARICOM. I really believe that Guyana is properly positioned to sidestep the deflationary global cycle that I mentioned before, as long as fiscal stewardship is maintained as part of its global blueprint of growth down here. I say to the great people of Guyana, congrats and enjoy the long overdue accolades that this nation needed so badly. Please take to heart past lessons from other Caribbean countries that turned their respective ships around and successfully navigated newfound wealth with discipline and solid international partners that can assist you in your quick steps to an extremely bright future. With that, let me close by thanking the Jamaica Stock Exchange and allowing me to address you this evening. I'm very hopeful that this year's conference will be an enormous, successful event and will be repeated for many, many years to come. And Marlene, thank you as always. Chairman, thank you. And I appreciate it. Good evening.